slowly just admitting people into the room. So again, welcome everyone this morning to our webinar on financial survival for entrepreneurs. We're slowly going to be adding everyone into the room here who's joining us here today. So we'll just take a minute or two to do that. And again, welcome everyone. Thank you so much for attending today's webinar to learn all about financial survival for the small business owner. Now, as we get started here, or before we get started, I just wanted to maybe ask a couple questions in the chat here. Just wondering where everyone is joining us from across Alberta. If you wouldn't mind just typing in the chat, we'd love to learn, yeah, what city or town you are joining us from. And feel free to also include what is your business? What type of business do you have? Is it a restaurant? Is it a daycare? Handyman business? Maybe you're an online store. Would love to learn a little bit more about each and every one of you. So again, feel free to share in the chat where you're joining us from and also a little bit about your business. Okay, we have some results coming in here. The major centers, Edmonton and Calgary, that's great. Someone from Bowden, that's perfect. A bit of a smaller community. And then for types of businesses, oh wow, we have quite a diversity. Everything from daycare, manufacturing, design, consulting, fashion designer, of an online store. Those are, yeah, some really interesting businesses. So great. Thank you everyone for sharing. It's 11 o'clock, so we're going to get started now. So my name's David Beta, Manager of Client Services here at BusinessLink. And as we get started here, I do want to do our land acknowledgement. BusinessLink acknowledges and respects that we are on traditional land, meeting grounds, territories, gathering places, and traveling routes of Treaty 4, 6, 7, 8, and 10, and the home to many First Nations, Métis, and Inuit people. In the spirit of reconciliation, we acknowledge the lands of those who have come before us, reside here now, and in the future. And today, again, our webinar is on financial survival for entrepreneurs. And our presenter for today is Anshuman Tyagi. And I have a short bio that I will introduce our presenter. Anshuman Tyagi is currently serving as an enterprise architect within the federal government. Previously, he owned an IT consulting company catering to clients in both the federal government and the government of Alberta. His academic background includes earning an MSc in Computing Science from the University of Alberta in 1993, after which he relocated to Ottawa to pursue his career. Anshuman has amassed extensive industry experience, having worked at renowned establishments such as Bell, Northern Research, Northern Telecom, and Nortel Networks over a span of 15 years before venturing into entrepreneurship with his own IT consulting firm. Beyond his professional endeavors, Anshuman has actively contributed to various nonprofit organizations, holding board positions and volunteering as a treasurer. He brings a diverse skill set to the table, holding certifications as a professional engineer, project management professional, and chartered professional accountant, reflecting his multifaceted expertise and commitment to excellence in his field. And so again, thank you so much, Anshuman, for having us here today. I will quickly mention if anyone has questions, feel free to type those in the Q&A box. We'll try to get to as many as we can throughout the presentation. You can also use the chat box as well. And today's session will be recorded and we'll have it uploaded to the BusinessLink's YouTube page by tomorrow. So on that note, I will pass things over to Anshuman, and we have 1 hour here for our webinar. So welcome.
Thank you, David. Good morning, everyone. My name is Anshuman Tyagi, and I am a CPA. It's a pleasure to be here today to talk to you about growing your small business into a small, medium enterprise. We'll be here for about an hour. And I think there should be a copy of presentation which is shared with you through the chat probably. If not, you follow along with the slides which we are showing. If you have any questions, you can ask me during this presentation. So one important thing which I want to highlight is that this session is presented by CPA Canada. CPA stands for Chartered Professional Accountants. Accountants work with numbers to help keep business honest and successful. CPA Canada is one of the largest accounting organizations in the world, representing more than 220,000 CPAs across the country. Canadian CPAs are recognized and respected across the globe for their knowledge and integrity. Some CPAs work in accounting firms, while others in industries such as entertainment, sports, technology, nonprofit, and many more. Depending on their specific job, CPAs can be responsible for making sure a business financials add up, managing budgets, and developing plans and policies that help grow the business. So this is something which I mentioned about CPA is asked by CPAs to talk to the people who are attending the seminar. So that's what it is. So now we'll get started. We'll move to the next slide. So here we'll talk today about how we grow your startup business to a small SME size. And I will be covering today in an hour, go over the introduction, a very brief introduction, then we'll go over the key numbers to understand and monitor, and then statement of cash flows. We'll do some math like ratios, which are very critical and help you to know where your business is, how it is doing. Then we'll have two exercises. One is a matching exercise, which basically to check your knowledge. It's a knowledge check, how you are able to understand the topic we are talking. So you can do that. And then there'll be a group session, which basically look at a company called Scarves of the North. It's a case study, and there will be certain questions which you can answer. Then we'll talk about effective tech strategies, managing growth and expansion, and then financing, also how the financing can be done, followed by tools and resources, which is something, links has been provided, which you can use in your, like after this seminar, and use those links to do more research and see how that applied to your business. And if we have time at the end, we can do some question and answers at the end. Main thing to note here is that effective tech strategies and financing, these things are something which will not be covered in very much detail, but we'll talk about it because it's a very important piece of how to make your startup business a bigger enterprise. So we can go to the next slide here. So we're just to introduce what's the definition of a business, what are the different business types. So according to Industry Canada, a small business is one which has got 1 to 99 employees. Medium is 200 to 499, and 500 more is considered a large enterprise. So just for numbers, like we have got about more than 2.5 million businesses in Canada, but majority of them, like more than 50% of them are really solo ventures, like there are no employees for the company. The employer, self-employed person, is managing their own business and they are the only employee. And within Canada, there are about 3,100 or so employees, which are large, which is about like more than 500 employees. So that's how out of the 2.5 million, there are only 3,100 with more than 500 employees. So we are really not targeting there, but we are thinking of how small and medium size, what are the basics you need to know as you move towards becoming your small business, becoming a more medium-sized business. Okay, so the key numbers to understand and monitor, it's very vital that for those numbers, because to understand and monitor, the most important thing is that what you are using to get those numbers, that they have been accurately kept, so that what you are using them for, you can make the right decision. So it's really vital that you have got good and accurate monthly bookkeeping, and you need accurate records to run your business effectively then. So basically, important it is a good bookkeeper, even a part-time one, is worth his or her weight in gold. Don't wait until the external accountant, like you are doing your taxes and you are going at the year end within the next few months of at the end of your fiscal year, financial year, that you're going to the accountant. It is important that you have all the information being gathered, accurately recorded and all throughout the years. So it's important to keep in mind also who will do your numbers. Like it's not, you may be very busy with your business, so you may not have time to do it. So it may be your partner who can do it, spouse or kids who are available and have time. You may be very busy with your business. So you can also think about some part-time help or full-time person who can help you. And if you do hire someone, think about the quality and really obtain references of the person who will be doing your bookkeeping. So once these numbers are there and you've got a bookkeeper and you have got good record, some people are good at it, they can manage it themselves. But if you are not able, don't have time, then please find a person who can look at the numbers, because the numbers are critical, because those numbers will be used, your recorded numbers will be used to come up with different ratios and also that it could be used. Another important thing to remember is that when you have these key numbers like the ratios and all, it's very important to compare it with the prior period, because you need to know where you are compared to the previous year. And it may be that you are just starting the business, so prior period may not be applicable, but if you are being there for a few years, you need to know how your business is doing year over year. Then other one is you may have a budget for the year, so you need to see periodically throughout the year how you're doing along with your budget, and also how you are doing with competitors, because every business has got different numbers. Every business type have got different margins, and also you have to see how you are doing along with your competitors. Okay, so the first number, which is sales, gross profit, revenue, sales, gross profit. So this is where it all starts, like sales. How much you need to know what is the total year to date, and this, if you're using a bookkeeping program, it makes it much easier to keep track of the sales. And the sales are really how much you have invoiced the customers, excluding the taxes. So it's the first important thing to know. The other important thing is the gross profit. So sales minus the cost of sales. And the cost of sales could be material, like which you can really directly assign to the things which you are selling. And it could be the material cost and all when you're selling the goods, or it could be if you hire somebody, like if you're in a service sector, for example, and you hire a person subcontracting the work, then the wages you are providing them for that particular work. So it's a direct cost for the things you are selling. So that's what the cost of sale is. So in this case, it's just a simple example here. We are giving that if the revenue is 100,000 and the cost of goods sold is 36,000, so the gross profit will be 64,000. But again, it's the direct cost attributed to the cost of the goods you are selling. Okay, so next is that you have done gross profit, but there are other expenses which you have not assigned to the goods you are selling, or directly to if you're in a service, to the wages. And those expenses are grouped into different categories, like operating, administration, selling, marketing, and depreciation. So these basically are, you're grouping them in different categories so that you don't have to worry about each and every line item, and then you get lost in so many things. So you group things, logically, you think that they belongs to one area. So you can do that in like for operating like some utilities expenses like heat and hydro. It's required to operate your business. So you put that in your operating expenses. So it depends. So main thing here is that if you have got a very detailed list of expenses because you want to keep track at when you are analyzing it, it may be too much. So, or if you say, oh, this just a one line item total expense, and that's the number you're looking at, that means that it is too high level and you will not be able to find out which area you want to reduce the cost. So it should be a balance, and depending upon your business and how you prefer to do it, you can decide to how you want to divide the expenses into. So very simple example shown here is you got operating expenses, administration expenses, selling expenses. So you got sales commission, for example, you should provide to your employees or to your subcontractors. So it will come under selling. Marketing is that you want to advertise your business, your products and all, so you put in the marketing cost. So marketing cost you cannot not attribute to the cost of goods sold because you don't know what's the impact on individual items which you're selling. So marketing is grouped together. And then depreciation is something which is accounting expense, which is there, where you divide up the cost of a capital expense over the life of the asset which we have purchased. So that's the depreciation cost which we're dividing up. So here the operating profit, which is shown as 20,000 when you take into account. Okay, moving along, these are two other important numbers. First is the operating profit, and the other is EBITDA.
Hi,
And-
Anshuman. Just a question here, may be relevant. How do you determine the depreciation?
Okay, so depreciation, it depends upon, I'll just go back to the, okay, depreciation, okay. So like generally I can use the same one as CRA provides it, and CRA has got a capital cost allowance kind of booklet, where they talk about if it is a building which you own and how you depreciate it. If you bought some computer, how you depreciate it. So you can use, instead of two types of accounting, like one which you are doing it for your business and one for CRA for taxation purpose, you can use that. So basically you're determining how long is the life of the product which you have, and guideline you can use from CRAs. For example, a computer which you buy and you say it lasts for 5 years. So you bought the servers and all those things for like $20,000, and the life is 5. So you can do a linear this thing, which can say, oh, every year you will depreciate it by $4,000. So it depends on your on the equipment or the asset which you are depreciating, and you determine that way. I suggest using this from CRA, Canada Revenue Agency, has got some a booklet for their capital cost allowance, which they ask the businesses to use when they are filing their taxes. So you can use that as a guideline. But it's not mandatory for you to use that also for your accounting purposes, but for taxation, you have to use that.
Great. Thanks, Anshuman. And just one quick follow-up if we have time. How do you depreciate reused equipment? Is it possible?
Reused equipment, whenever you purchase the reused equipment, you must have reused, you mean like used good. So you can use that, you know the cost of how much you bought it for. If you're not able to, if you know, then you can have a market value of it. So those are the things you have to use to know how much it's worth.
Great, thank you.
Thank you. Okay, so we are talking about operating profit and EBITDA. So operating profit is also earnings before interest and taxes. So this is the core of your business. Are you making money before the cost of financing it? So And if you aren't, then there's no point doing that business because you don't have any savings. You are like even you are not able to pay your interest. You will not have the money left for paying the interest also. So it's not worth it generally, but it depends upon if you're a startup company, the first year and all, you know that it takes time to establish. So that's okay. But if it is a ongoing business and if your EBIT is not positive, it's not worth continuing the business. So you have to look at this number. So it is earning before interest and taxes. Another one is EBITDA, which is earning before interest, taxes, depreciation, and amortization. So it's similar to operating profit, but excludes the accounting allocated cost of your fixed or capital assets like office and computer equipment. And it's a rough measure of operating cash flow. And remember, cash flow is your business lifeblood. So it's critical. This EBITDA is there because you are not putting that the required accounting cost into this mixture. So it will give you a better idea of your cash flow. So this sometimes EBITDA is useful to use. Okay, moving along, and I think we'll talk about another one, which is the net income before tax.
Oh, sorry, Anshuman, just a question about the EBITDA. Is EBITDA sufficient to account for our earnings?
Sorry, I didn't get that what you said.
Is EBITDA sufficient to account for our earnings?
Earnings. I think we'll talk about net income. Like it will, like you will get more ideas as we move along.
Okay.
And EBITDA, like yeah, net. We'll talk about these things in the.
Perfect. Okay, thank you.
Okay. Okay, so net income before tax, I think it will answer what you may be looking at, asking. So this is the bottom line. What is left after expense have been deducted from revenue, and it has got interest also. So because you have to pay interest because you have some loan, so EBITDA was not good enough because this didn't include this. It was having the money before interest and taxes. So interest has to be deducted also. So if it is negative, if this value net income before taxes is negative, that means you are in a loss. And I don't know how long you will be willing to have losses. I did mention startup, you can have loss 1 year, for example, 2 years or so, because you are establishing yourself, but you have to think how long you can sustain a loss. So I remember a lot of people continue to operate a losing business for too long, thinking that, oh, there will be you can be able to turn course and be able to start making profit, but you have to really think hard and know when to, and also it's very important when to cut the cord and move on to something else, because you have tried it for a few years and it's still net income before taxes, for example, is not there. So it's negative. So it's no point pursuing. So the earnings really is similar, is what net income before taxes is. And then after that, there is tax also, which you have to pay. If you're making profit in earnings, you have to pay taxes on it. Okay, so this is like very important. The cash management is really the focus of how the cash moves. It includes money and accounting together. And as an owner or manager running a small or medium business, you know the importance of cash. So accountant may help you measure the net income because all those things are accounting thing, but you as a business need to know how much cash you have in hand and access to cash when you need it for some work. Oh, you want to buy some inventory, so that cash should be there. It may be available at the end of the year, but you don't want, you want it now. So those things are, the cash flow is very important. When is it available to you? So cash is at the center of all business activity. You need cash to start and expand the business, and cash to run it. And you need to generate cash from the different activities, business activity, financing activities. So you need to consider all these options. So here it's a very good good example given here. On the left hand side, it talks about how the cash is coming into your business and how the cash is going out, which is on the right hand side here. So it says that cash at the beginning of the period, you have got $17,000 at hand. And how will you add more to this cash? You have operating activities happening, which is like cash sales. So you're getting cash for the sales. So you have to consider that. Other one is you had your clients paid through credit cards, and then you are doing the collection of it. You are getting the money now from the credit card company. And also you have given to paid, you sold something to customers on an installment basis, and you're getting customer payments periodically. So the total operating activity cash inflow is 90,000 in this example. And then you may have loan. You talk to somebody, your friends, family, bank, or something to get, you got a loan because you wanted to expand. So this is loan proceeds, followed by owner's investment. Like owner wants to expand the business, or there's something needed, the owner themselves can put money, so that's owner investment. Maybe you have got surplus asset which you purchase and you want to sell it to generate some cash, so that's another inflow of cash. So from there you say, oh, how much is the money coming from financing and assets activity? So that's on the left hand side. It categorizes how the cash is being received. And then on the right hand side we talk about how the cash will be is going out from your cash bucket. And it is sorry, I'm getting some messages there, but so inventory purchases is you have to buy new inventory, so 26,000, followed by there may be operating expenses, as we discussed before in the very beginning. There's operating expenses to run the business. You have to pay interest on your loans and the income taxes because you are earning. So that's operating expenses they are going on. Then for the financing activities, they may be for financing activity which you you got a loan, but now you're periodically paying the loan amount also. Like so those are the things shown here. Dividends, your owners are paying themselves or a dividend. So these are the things which are showing the cash flowing out from the business. So the total cash paid here in this example, 127,000, which sums up these two from the two different activities, and which is deducted from how much cash you received during the same period. So at the end of the period, the difference between the two is added to the beginning period. So that's how you get the cash at the end. So this is quite important, from where the cash is coming in, cash is coming out. And also something which we need to consider as small, medium businesses is when it is coming, seasonality and all those things. So it may be certain seasons are very important where you earn a lot of revenue, but certain seasons are where you are stocking up your inventory. So you are spending more money, but you have to make sure that you have got the money there when you want to buy the inventory. So even though for one quarter, you may be having a lot of cash inflow, but you may not have that cash inflow in the other quarter because that's not your peak season, that's your lean season. So you have to plan accordingly as a business. Okay, moving along, then Other thing, which is another number which is quite important, is statement of financial position, and it's about two things which we want to discuss here: is account receivable aging and accounts payable aging. So it's about account receivable aging is very important, very vital for your cash flow. If you don't collect on time, you will have to finance your operation with more debt. So at the example, what I was mentioning for lean season, but you have to prepare for, you have to have more inventory for the next season. So you need to know for this cash flow, when the money is coming, when will you collect the money so that you can put it for your inventory. So it's very important if you don't collect when you are doing the account receivable, if you don't collect on time, you will have to finance your operation with more debt, and that costs you interest. So usually what you should do is that if you are, account receivable is something that you have sold something to a customer on credit, and you are expecting them to pay in the next 30 days, 30 to 60 days or so on. So just make a list of when the cash will be coming in for the one you are anticipating to receive. So that's account receivable. Accounts payable is that this is how much you owe to your suppliers. So you may have bought some inventory, but you worked with the supplier that you will be paying you in the next 30 days or next 60 days. So it is very important that you need to know when accounts are due to avoid late payment charges, but also take advantage of paying it when it is due. So instead of, and unless there is an early payment discount, so that you can say, oh, if you pay right away, you will get 10% discount. But if you wait for 60 days, there's no benefit. So you have to decide how you want to use it. So attention to these things, receivables and payables makes a big difference between a profit and a loss. Okay, so here, so we were talking about raw numbers, like individual numbers and all those things. But here is something called ratios. So we put one over the another. We do like divide and all those things, one number with another, and then see what is the ratio. So basically what we are trying to do with ratios is normalizing it, so that when we talk about raw numbers, it's like thousands, millions, so it's very like changes. But when we do the ratios, it is in percentage. So it's 0 to 100%, for example, or could be negative. So it's more normalized, and it's better to talk about normalizing, because then it's easier to compare with previous year and compare with your competitor also. How much is the margin and all. So here we are going to talk about key ratios, which will be like or like next few slides, we'll talk about gross profit margin. We'll talk about operating profit margin. We'll talk about current ratio, quick ratio also, which is like the banks and all, they use quick ratio a lot. Account receivable turnover, how long it takes for you to receive your accounts back or your money back from your customers, and debt to equity ratio. So those things are all these ratios are critical and important. And also towards the end of it, I'll just give you a few minutes to do our matching exercise, so that to make sure that you understood these different ratios. So gross profit margin is really gross profit, which is sales less cost of sales divided by the revenue or the sales. So, and this is very important when compared to prior figures. So previous year, how much was the gross profit margin and how much is now? Because that way, are your cost increasing, and that's why your gross profit margin is decreasing. So you need to know that ratio will give you, okay, it was 60% last year, but it's now 55%. So is it that you didn't increase your sale price so that you could have the same margin? Those things. So like, for example, very large public company, everybody has heard about like, for example, for their Apple Watch, Apple looks at this number very closely, and they need to know, are they maintaining their prices to keep the gross profit margin high? So for example, if the cost is increased, then they will increase the cost of the price also. So like big companies, everybody, this is a very vital number they look at. So it is vital to analyze your products separately, which are contributing to the highest GPM. So the products which are contributing the most to the gross profit margin, you may want to concentrate more on them. And then the one which are performing less and you don't see the potential in the future also, you may want to discontinue with those ones. So it really gives you an idea of where to concentrate your effort and the company focus.
Hi,
Other one is, yeah,
Anshuman, just a question. Are we calculating all of these numbers without tax? Like when I purchase supplies, they have a cost,
yes,
and
yeah.
then tax on top of that. Am I using the pre-tax number or the full cost of the
No,
supply
like
order?
here, like when we talked about, like when we were talking about the sales and all those things, we excluded the taxes. And so like we we didn't we don't include we didn't include the taxes here.
Great, thank you.
Okay. And I think that was mentioned in the slide, in the very beginning of the slide when we talked about sales, when you're looking at the sale number. So we are using the sale number that way. And also, the important thing is consistency. You want to do it. This is for you, your business, and how you want to do it. But year over year, follow the same pattern. If you want to include taxes for your case, you can do it, but follow the same things because the numbers, the underlying numbers should be consistent to come up with these ratios. So the next one is operating profit margin. And operating profit margin is equals profit excluding interest and taxes divided by revenues, which we talked about before. So that's operating profit margin. I want to go a little bit faster. The other one is current ratio, which is current assets over current liabilities. So when you are talking about how much assets you have and how much is your liability, and those are current, that means within the next year, the cash in hand. So you are not using, like you've got a building and you can sell it because you own it, you can sell it, but that's not a current asset because it's a long-term asset kind of thing. So you have to look at current asset, like a investment which you have, your savings and all those things in your current assets. So this is a measure of company's ability to pay short-term obligation, and a value of 1 is desirable to for this ratio. And next one is quick ratio, and here it's about like inventory and prepaids, because inventory also turnover is quick within the next few months. But for quick ratio, we don't include inventories as well as prepaids. That means you already paid your supplier and you have got prepaid. So you exclude that because that money is not in your hand, even though it has been counted as your current assets. So you exclude those things, and if you exclude those and over current liabilities, that's a quick ratio. And this is something, this is a key metric which bank uses to find the financial solvency of the business. So they will use this number when you go to them for a loan. And depending upon how good your ratio is, they determine the risk factor, and the risk factor determine what is your loan rate. So definitely a higher value higher is one is desirable, as it indicates the business has sufficient assets to pay off current obligations.
And Anshuman, question, will the amounts receivable also be added to the numerator assets?
No.
Okay.
This is no account receivable yes, I think account receivable is considered as a current asset, so it will be already part of the current assets. you will have over periodically, like what happens is that you may have sitting some, and you have to periodically go back and look at your accounts receivable and determine how much you have to write off and all those things. But current assets, yes, you will have that because you will receive it in the next 30 days, 60 days, and all those things. Here, the prepaids and inventory is different, but current asset will include the account receivable, which you are expecting within the next few months from your customers whom you have sold the goods. Yes, it should be there.
Great. And are virtual items also assets like domain names, or is that a operating expense?
No, they will not be. They are not considered current assets there. They are some goodwill and all those things that you can. But those are not current assets. They may be put in your on your books when you are for accounting purposes. But
Perfect.
it's not something which you can immediately monetize, or it's not something it can be used to buy your inventory, for example, or you cannot go with to the bank. It will not help the bank to say, oh, you have a good domain which could be sold because you have, so it will not be used immediately. So it's not part of the current assets.
Okay, so only tangible assets will be included?
Which could be which you can, like for the current assets, it's something which you have in hand really. It's not a tangible asset like for example, I talked about building. Building is a tangible asset, but it's not something which you can sell anytime. So current asset is more about the money you bank in your savings account, or some short-term investment which you have put, current assets. And also account receivable because you are getting the money there. So those are the current assets.
Okay, thank you.
Another one is the account receivable turnover is like net credit sales, how much money, how much goods you have sold on credit, which is the net done, and the average account receivable. So generally we can say, okay, on the last 2 years, how much has been the account receivable, and you do the average of it, and this is, it says. So if you got a very high account receivable, which means this ratio will be low, which means that it takes you longer to collect your money back. So here in this example, if this was instead of 20,000 average account receivable, if it was 50,000, so 50,000 average account receivable means that the ratio will be 4 from this side on the net credit sales and 50. So it means that 365 divided by 4 will be like about 100 days almost average, approximately, to collect your accounts receivable. So you really want this ratio to be high, which means that you are able to collect your money faster. Okay, then the next one is debt to equity ratio. This shows how leveraged the company is. So how well your owner's equity is working to get the money. So are you leveraging your business through debt? So sometimes we feel debt is bad, but the thing is that if on the debt which you have from the bank, you are able to make a lot more money, that means the return is much greater than the loan interest you are paying. So that is good that way. So this ratio is giving you how leverage your business is. So if an owner is putting 100K and 100K, and the liabilities you have, the loans and all those things which you have got from the bank is less, that means your money is not being leveraged as much. So we talked about the different ratios which are important for a small medium business. I have got a matching exercise. If people can quickly look at it, I don't think we've got time really to spend on it. So if you want, you can take a look at it, but I think I will just skip this exercise and we'll go to the next exercise also. But it is basically, it gives you, I can share with you if you want what that exercise is about. on my screen.
And Anshuman, is a higher leverage, for example, higher debt better or worse?
Yeah, see, higher debt is better if you're making profit. The thing is that if you are making profit and you're a lot of money, the debt is not bad to have. So if you are able to make 10% money on the debt you have, and you are paying bank only 4%, then there's a difference of 6% you are making on. So it's good. So you have to consider, you cannot say debt is always good. You have to see whether debt is helping you to grow your business and make money. So the question is really uh, how whether it's a good debt or a bad debt, and it depends on the business. Okay. So this is the exercise. Basically, it talks about the ratios, and then it gives what is the description, and you just have to do the matching of these in this exercise. Okay. Okay. So I think we'll go to the next one. So this case study is really more about a business, very small business, and they are selling different. They are selling scarves, and they are selling it through different channels, and it's year over year. The information is provided to you, and you need to see whether this is how is the gross margin changing year over year. How is the revenue growing year over year? And this is something which, as a business, you should look at. So I'm just sharing you must have got it in your with the slide. So here in this case, they gave a case. What's happening here? They sell custom made knitted scarves, and they do it through retailers and directly through website. So if you see here, year over year, the revenue is sales are increasing year over year. So and the gross profit is increasing also year over year. But you need to know the ratio to determine whether the gross profit is increasing or decreasing year over year. You just can't look at these numbers and see, oh, my profit is increasing year over year. But you have to see, oh, year over year, this was only cost of sales was only $600, but here it is 10 times more. But has this profit increased 10 times? No. So you will see that the gross profit is decreasing over time. So that's why the ratio becomes important to look at. So this is one thing you look at, and I think it has provided by what amount and what rate the sale is growing each year. So you can do that math, basically 9100 minus this thing divided by 3500 will give you how much is the sales growing. And so this is some exercise. Probably we generally don't get time to do this thing. It's just short period to do it, but this exercise is a good thing. It's a very simple one, but it will give you reasons of what to look for. Your business may be much more complex, or maybe you will be able to relate your business to this example and understand accordingly how to analyze it. So here I'm giving you just going through those. We didn't do the exercise, but I'm just going through the questions which they were asking. So here we are saying the revenue has grown, but it was 160% growth in year 2 compared to year 1. But in year 3 compared to year 2, the growth is only 59%, and year 4 is 35%. So as you know, like in the initial year, the revenue growth may be faster, but over time it stabilizes. But you have to make sure that it stabilizes properly with good profit margins. Other number, the gross profit margin, which was the gross profit over the revenue or sales, is decreasing over time. So you can ask, why is the gross profit margin decreasing when my revenue is increasing, for example. And the example could be, is it that we are not increasing the prices according to our cost increase, for example? Also, in the example, the channels were the way how they were selling things. They were selling things through website and through retailers. So website margins were much higher, but to the retailers, the margin were less. So are we concentrating more towards retailer and we are cutting on our margin because our retail margin is less? But if you're sold it through our website, like which a virtual channel, our margins are better. So that helps you to know why. And you ask the question, why asking these questions, why, will help you to point out where to concentrate on. So in this example, if you go back and do it, you will find out that, oh, the website, selling through the website, if you sell only one item, you have a gross profit margin of 83%. But if you're selling 10 or more, it's 80%. But if you go through retailers, the gross profit margin is only 50%. So that's the thing we have to look at. Also, that was on the top half of that numbers sheet which we looked at. Then we look at the admin side, the expense side also. Admin has increased. Admin cost has increased over time. So why are they increasing? So you have to look at, for example, in the beginning, you were not paying yourself or you are not paying your relatives in the first year, but now you're starting paying your relatives certain money, then the cost is increasing. So you look at those expenses also, why the expenses are increasing, which basically look at other reasons why the net income is decreasing. So basically, these ratios will give you, will help you to when you ask why the ratios are changing, it will help you to go back to your numbers, which you have been collecting over time, your bookkeeper and all those things have collected, that to get your answers. Okay, now we are moving to another topic, and this topic is like, I will cover it very quickly because this is something very specific. It requires more detailed knowledge of your cases, of your business, and you need probably have an accountant to work with you to determine that. But I will just briefly talk about it. So corporate income tax rate. So these are the few factors we are listed when to create your effective tax strategies. One is income tax rates, because corporate income tax are lower. And since January 1st, 2019, the federal income taxes are 9%. But then on top of that, they are provincial has got also small business taxes also. So overall rate is more than 9%, but definitely it's less than the personal income tax you pay. So you have to see that. So small business interest tax rates are for businesses which have got maximum revenue of 500K. But it could be adjusted. Accountant can tell you something if you how this limit can change. So main thing is that corporate income tax are less, but then you have to keep the money in your business, and you don't get the money in your you cannot pay wages. So the government gives you a lower corporate income taxes so that you can grow your business. And when you grow your business, you will be giving jobs to other people. So that's why they put it there. But so that's one reason, one thing to look at. Other one is salary and dividend decisions also, which is that you pay yourself instead of wages dividends, and dividends are taxed at a different lower rate when you do your taxes. But the thing with that is that you are not it's not considered as earned income, so you cannot get deferred tax benefit as you get when you do RRSP purchases and also purchase of CPPs. So government has done, they do a good, they balance it out so that people are not taking advantage of paying themselves through through dividends only, because if you pay through dividends only, they don't allow you to buy RSPs, which helps you to defer taxes on your personal income taxes. So it's overall, depending upon your scenario, depending upon your situation, you may decide how much balance you want to have as dividend and how you want to do salaries. Other one is management fees. This is basically more about your investment when you're doing investment and all those things. How much is the management fees charged for investment purposes? But you have to make sure that those management fees are really are paid for investment purposes, and they are being done to earn some income on your investment. Also, there is some income splitting also there, where you can, if you have a spouse or a children working with you, if they are working for you and the business, and the CRA makes sure that that they are contributing to the business, that if you pay them, because they may not have another source of income, or they've got a source of income which is lower, they may be taxed at a lower rate. So, but the key thing is, CRA definitely requires you to prove that you have paid them because they did some work for the company. Also, dividends to the family members, to people who are part of the business, they are the shareholders. To them, you can pay dividends, and the dividends, if the person who is part of the corporation and contributing to the company or working for the company, they will be taxed at a lower rate for dividends. But if they are they are not directly working, they will be taxed at a higher rate. Also, there's something called differing taxes with a bonus thing. Is that you can put in your books that a bonus will be paid. So for your corporation, you may put a bonus as a cost and as expense, so you don't have to pay interest on the income you earn in the corporation. But to yourself or to your family members or the shareholders, you can pay the bonus the following year. So that way, they will be taxed in the next year income taxes. But as a corporation, you have done it, you have claimed the benefit in that year. So these are various strategies which you have to look at to make sure, but it depends upon your situation. So it's for you to determine what suits you, and that's why it's recommended that you should discuss this with your accountant.
Anshuman, I'm just looking at the time here. We have about 5 minutes left,
Yes.
so I know you have a few
I
slides.
will quickly cover, like, this is like very quickly, I will be covering these things. So now another one is managing growth and expansion. So sometimes entrepreneurs see, oh, the business is growing very well and all, but they may have forgotten that, oh, this is one particular season that the growth is happening. So the main thing is, if you are planning to expand your business, because expansion needs investment means that you are putting your own money or you are getting the money on loan to invest and to expand your company. So make sure that there is definitely a demand for your product or service, and then only you expand. So best if you are busting at the seams, there's so much business, you cannot handle it and you need more space, then only you decide to expand it. And also, when you expand it, do you have the manpower? Do you have the people to help you grow the business? So these are the things you have to see. And also, you have to see additional cost needed to expand all those things. So these are the factors you'd say. So it's not always good to expand, because if you expand, there's a cost involved, and you need to make sure that your margins remains still good. That expansion helps you to improve your bottom line, which is very critical. Okay, financing. And this is talks about the big league, that means really you want to go beyond your means, and you want to go to a big banker and to get more money. You want to do private lenders, venture capital, and all those things to grow your business uh, beyond your uh, means right now, because but your business has done so well that there are people who are willing you to lend. So for those things, generally you need to create a good proposal which explains what is your product doing, what service you are providing. So they need detailed information about your product, and you have to convince somebody else outside your core group of people whom you're working with, your family and all, that your product is really worth their investment. So there's a proposal they look at. They look at the numbers. They want to see the numbers to support your proposal, like how much is the cost to increase, how much computer or machinery cost will be needed, and all those things. And these, once you have the proposal and the numbers to prove, and the source of investment could be banks who are very they are not as they're very conservative, so it's hard to get money from them. But there are private lenders who take the risk, but they will charge a big percentage of your money to give you. They may say they will want to have equity stake in your business, or they may give you a loan for a very high percentage. And the last one is crowdfunding. Is basically you can have like a Kickstarter kind of thing. You can sell product beforehand. Okay, so this is crowdfunding. You can get it. And then here are some tools and resources which you can have use in your spare time to search more, and they will give you more information about what to look for small and medium business and how we can grow up. So thank you very much. I feel I had to rush towards the end, but those were the things which were spending less time. Okay, if there are any,
Awesome.
yeah, last
Yeah,
minute question I can take, but
Yeah, thank you so much, Anshuman, on providing that clarity on financials and taxation. It's such a huge and important topic for really every business. And we hear the cliche saying cash is king, and it
yes.
really is true, right? I think you did cover a ton of really great content. Folks will be able to reference that through some of the recorded video, like we mentioned, will be available on our YouTube page tomorrow. You also had some great handouts and the slide deck as well. Folks can reference some of those materials and resources. Really good questions coming through. We were able to answer some of them as they came through in the chat. So I think that was really great. I did put in the chat a link to connect to a business strategist if anyone has additional questions. Again, we're not accountants at BusinessLink, but our general business strategist will be able to provide you with a little bit more guidance and information. I know when we are done the session, when we're wrapping up, we will have a very quick short survey rating for those of you who are still on. If you wouldn't mind filling that out, that would be much greatly appreciated. So keep your eyes open on that. Um, and yeah, I'm just going to see here if there's any really quick questions. Um, yes, I think some of these are a little bit more detailed, but again, I think in the presentation, folks might be able to reference some of the information again in the video to cover some of those topics. Any last little bits of advice, Anshuman, you'd like to leave us with?
I think we started with that one, that keeping the numbers. Bookkeepers are very important. Like it may be your friend, it may be your family member and all, but keeping accurate numbers are really important for you to understand your business. And numbers help you when you ask question about ratios. It gives you the reasons to look at your numbers which you collected and find out where you want to improve. So that's it. And I think hopefully this presentation was useful. Your handout, which have been provided, you can use it and help you to grow your business more, and you flourish in your business.
Awesome. Great. Thank you so much, Anshuman. And take care, everyone. Have a great afternoon. Thank you.
Thank you. Bye bye.